Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 20th of August. I'm Daniel Lam, your host for the podcast. After the sharp recovery in risky assets that we saw over the last 8 sessions, many would be wondering if the correction is already over. Now, the release of the set of US macro data showed that the re-emergence of the hard landing narrative was perhaps not so justified. However, the consumption growth over the past few months had followed manufacturing sector's slowdown, and both are trending towards historically low levels. For the rest of August, however, there is actually much less US macro data for investors to latch onto. So, an analysis of the market's varying sensitivity to US data releases conducted by the University of Washington and the Fed shows that the vast majority of the economic releases that matter to investors occur in the first 2 weeks of each month by a sensitivity factor of nearly 6-fold. Hence, we will be left mostly with events to watch for as catalyst. So first of all, we have the Democratic National Convention that started this Monday. This event is likely to point towards a split Congress, and that's not the most positive outcome for risky assets. Jackson Hole is the other major macro event that will occupy investors' mind. Now, historically, this event has usually been hawkish for the markets, with US 10-year Treasury yield rising by 11 basis points in the 1 month after the meeting. Moreover, the 95 basis point worth of 2024 cuts currently in the futures market seems a bit excessive, both relative to the Fed's June dot plot as well as in relation to the underlying macro data. The gap between the market implied Fed funds rate at year-end and the macro data implied rate has widened to the largest level over the past 12 months. So to sum up, there is quite some bit of risk for the US 10-year Treasury yield to back up by 20 or even 30 basis points in the near term. Now, historically, the yield-equity relationship tends to turn negative when the 10-year yield rises by more than 20 to 30 basis points over a 3-month period. Hence, for those who feel that they have failed to catch this correction over the last 2 weeks, do not despair, because there are likely to be opportunities for you to scale into assets, such as US growth stocks or US 10-year government bonds over the next few weeks. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.